Happy Friday. I'll just jump into my section here, summarize kind of what I talked about. So obviously we had FOMC meeting on Wednesday, so pretty volatile week across the markets. I don't think that should be too much of a shock for anyone to hear. And as you probably know, the Fed decided on their fourth consecutive 75 basis point hike to the Fed funds rate, which was in line with market projections. So now our target range is 3.75 to 4% for the Fed funds rate, which puts the market interest rate at a level in line with 2008. But as you know, you may know if you're a newsletter reader every week, the markets tend to react more to the Fed chair's speech rather than the actual decision because markets are forward-looking. So as of Tuesday, 75 bips was priced into the market, but what wasn't priced in was the tone and outlook that Powell was going to portray in his speech. So which I guess shouldn't be too much of a shock based on, if you've been watching the markets at all, is that Powell took a more hawkish approach in this news conference. And he said that they would rather over tighten than under tighten. So, in the chair's eyes, the potential liquidity crisis that would come from an overly aggressive Fed is less of a threat to the economy than persistent inflation that would come from the Fed acting too timidly. But whether or not you agree with him is, solely up to you. And I think there's strong arguments on either side. Powell did say that we'll likely see a reduction in the size of rate hikes over the next couple of meetings, but he also stated that previous terminal rate projections were likely too low. So, for those who aren't aware, the terminal rate is the level that the Fed funds rate is expected to reach before policy changes and interest rates are lowered again. So it's kind of that peak, but it's speculative. So nobody knows for sure what the exact terminal rate will actually end up being. But this speculation amongst futures traders and Fed officials allows us to see what market participants are expecting. And because markets are forward looking, like I just mentioned, expectations of future short rates are super important. In September, the median forecast for the terminal rate amongst Fed officials was 4.6%. Like Powell said, he believes that terminal rate projection is likely too low. So after the talk on Wednesday, the futures market is now pointing towards a terminal rate of 5% in the next 6 months or so. I believe it was by May was what the data was indicating. But in summary, long story short, over the next 1 to 2 FOMC meetings, we can expect to see the Fed move to a strategy where hikes are decreased in size, but are going to continue for a longer duration than we originally expected. So in my mind, this is a strategy for the Fed to manage risk. So all the policy actions that they've taken in 2022 are already extremely aggressive, historically speaking. So FOMC, or the Fed Open Market Committee, now believes that they can kind of ease off the gas to be more surgical, if you will, with their rate changes. And contrary to what some might have you believe, a reduction in the size of rate hikes is not a Fed pivot. And U.S. monetary policy is still overwhelmingly contractionary, and as Powell stated, it's going to continue to be that way for quite some time. But I think, it is possible that the reduction in the magnitude of these rate increases could signal to the market that, the finish line is in sight for the tightening cycle. But, so it's possible that markets could bottom around that news if they haven't already. But, of course, that's speculation and, no investment advice. And the next meeting for the Fed Open Market Committee is on December 14th. And then the following meeting is on February 1st. So, expect based off of what Powell said on Wednesday, for one of those meetings to have a 50 basis point hike. So if you look at the Fed Watch tool, which is a tool provided by CME Group for free, if you just Google Fed Watch tool, you can look at it. I look at it a lot, put it in the newsletter a lot. But they aggregate Fed futures data to determine probabilities of future rate hikes. Currently, for the December 14th meeting, they're giving it a roughly 50-50 shot of seeing 50 basis points versus 75 basis points. They're giving roughly 5% more chance to seeing 75 basis points, but it's going to change before December 14th. It changes almost every day. But as I mentioned earlier, Powell's speech triggered a lot of volatility in the markets. Right, there's a lot of algorithmic trading that happens on FOMC days. But according to this chart that I saw on Twitter from Bespoke Investment Group, Wednesday's session was the worst final 90 minutes of a Fed day for the S&P going back to 1994. So I just think that kind of illustrates just how hawkish Powell came across, and just the amount of fear that triggered in the markets. So on Wednesday, the S&P was down 2.5% on volume. That was 23% over its 50-day average. Yesterday, we kind of saw a continuation of that selling. This morning, when I was finishing up writing this newsletter, it looked like we were going to bounce higher, with the jobs report. Now we're seeing this reversal. Still 4 hours left in the session, so anything could happen. But just something to keep in mind. And I included a chart which I thought is pretty interesting, and it's the percentage of stocks in the S&P that are above their 20-day simple moving averages, and it shows that generally speaking, once we hit this range of 80 to 95% of stocks above their 20-day, the index is generally very extended to the upside and due for a correction lower. So this week we kind of saw that, with the index rolling over alongside this metric, percentage of stocks above the 20-day. And I highlighted, several occasions where we've seen this throughout 2022. I just thought it was interesting. I also mentioned, it's not uncommon to see that metric roll over and, show a slight decline in breadth, and that be enough to support a move back higher if, the buying is strong enough. Like I mentioned, today we're starting to see a continuation of the selling, but, anything could happen through the end of the session. From there, I kind of move on to talk about Dixie, or the U.S. dollar currency index, which has had overall a strong week. Today it's reversing back lower, but overall it's been a strong week. I give it two main reasons. The first one is the fact that this contractionary monetary policy reduces the supply of dollars, which works to increase the purchasing power of $1. The second reason would be the fact that higher interest rates in the U.S. increases demand for dollars because foreign investors are looking to, capitalize on higher yields for U.S. debt. So, with that, we're seeing overall higher yields from treasuries this week. Today, like I said, is a little bit of a different story. At least the 2, 3, 5 year are down. Their yields are down today, but some of those later maturity bonds are yields are up today as well. So, as I mentioned earlier, we got that jobs report this morning, which kind of led to a bounce this morning. We saw a slight uptick in the unemployment rate, which now sits at 3.7%, up from 3.5% in September. And we also saw a larger than increase in non-farm payrolls, which is super interesting because it's showing an increase in unemployment, but an increase in payrolls, which is the number of Americans joining the non-farm workforce. So we're seeing both of these metrics increase at the same time. Which is, it is possible. It's relatively uncommon, but the unemployment rate is looking at the longer term trend in employment versus non-farm payrolls, which is just looking at the short term, job market in the month of October. So in the short term, we're seeing this slight uptick in Americans joining the workforce. But when we take a step back to look at unemployment from this broader time horizon, we're starting to see a slight uptick in unemployment. Moving on to the crypto equity section, it's a shorter section this week, so I don't want to give out all the goods, but generally speaking, it's been a pretty rough week for crypto equities. Like I said, today we're kind of getting a bounce, but overall, it's been a negative week for crypto exposed equities. We had two more public miners announcing trouble upholding debt obligations, essentially defaulting. And I provided a couple reasons for why I think this is really interesting and why this bear cycle is different than previous ones. For Bitcoin TA, we're seeing a nice bounce today, kind of starting to roll over a little bit here, but overall a strong session for Bitcoin as well. But that about sums it up. Like I mentioned, not going to give away all the goods. I highly recommend going and reading the newsletter and looking at the charts.
That was a great breakdown, Blake. Correct me if I'm wrong, but you've said before that you believe unemployment rate is sort of a lagging indicator.
Yeah, totally.
Cool. So seeing that start to uptick is like, I guess that would be somewhat of a sign that a pivot is not like near, but like we're headed that direction. Because if unemployment's a lagging indicator and it's starting to slowly trickle up, then we might be be towards the end of the cycle. But one thing I was wondering when you talked about the smaller rate hikes, is that possibly the Fed just trying to, because the idea is right, is they're going to keep hiking until something breaks in the treasury market by slowing down and decreasing the size of the rate hikes. Is that them sort of kicking the can down the road?
Um, you know, possibly. Kind of the way that I see it is the Fed doesn't necessarily have to just increase rates until something breaks. Obviously, their goal is to increase rates to a point where nothing breaks and we can restore a little bit of price stability. Kind of the way I see it is, historically speaking, or maybe not, fully. Let's say over the last 20 years, a 70 or 30 years, a 75 basis point hike to the Fed funds rate is massive. And I think a lot of people underappreciate that just because, we've gotten four in a row. So, you get kind of used to it. But 75 basis points is a massive jump for the Fed funds rate. So if you proceed at this, magnitude of increase, you're going to break things a lot faster. So if you just reduce the size of your hikes a little bit, like I said, I couldn't think of like a really good analogy for it. I kind of like the word, surgical. They're being a little bit more precise with their increases. So, like Powell said, we're going to decrease the size of increases, but we're going to continue doing them for longer than expected, most likely. So that's kind of the way I view it as 75 basis points is huge. Let's take a step back so that we can, be more meticulous with our approach, if that makes any sense.
Yeah, Blake, I have another question for you. So I was looking back at the previous Fed funds hiking cycle, and basically it ended right around the end of 2018 and early 2019, which happened to coincide with the Bitcoin bottom of that bear market. It was about 3.5K. Do you think that whenever this cycle ends, or whenever this Fed funds hiking cycle stops, will that be the Bitcoin bottom?
Yeah, that's a great question. And that 2018, 2019 period is interesting, right? That's like the famous Powell pivot. But, in terms of will that be the Bitcoin bottom, I obviously have no idea. I would like to think yes. But also, as I explained earlier, markets are forward looking. So it doesn't necessarily take, you waking up one morning and the Fed has said, okay, we're done hiking rates. It's not, you don't have to wait for that for the market to bottom. The market's going to bottom, based on future expectations. So I think eventually we'll reach a point where, now kind of the finish line is in sight to an extent, right? They're talking about decreasing the size or the magnitude of these rate increases, but even further in the future, there's going to be a point where they say, we're going to be done hiking rates, period, or bringing them back lower in the near future. So, whether that will be the bottom, I don't know, but it's just important to keep in mind the fact that markets are forward looking, and the Fed is kind of, one of those famous quotes is the fact that the Fed's driving, looking in the rearview mirror, right? So they use a lot of lagging data, but the markets operate on forward expectations of future short-term interest rates, for the most part. So knowing that the finish line is in sight can cause the market to bottom. I think there's a strong argument that the market's already bottomed, but obviously I have no idea. I don't have the magic crystal ball, unfortunately. So there's no real way of knowing.
Does Powell have to say ahead of time, like when they plan on stopping the rate hikes, or could he just magically come out one FOMC meeting, they're like, yeah, we're not hiking anymore. In fact, we're going to cut. Or does he sort of have to say something ahead of time?
I think, yeah, it's a good question. I honestly, I don't think he necessarily has any obligation to, forewarn the markets of what they plan on doing in the future. And as they've said, they're kind of taking it meeting by meeting, not issuing forward guidance to allow themselves to do whatever feels right at the time. I think to an extent they like to sort of hint at what they plan on doing in the next meeting or two, just to kind of give the markets time to prepare and not cause some massive shock one way or another. But there's no real obligation to do or say anything.
It's just crazy how one man, his words can move markets so much in the short term. But I do think like we're gonna have to see a lower CPI print before he would start to come out more dovish. Would you agree?
Yeah, I mean, I think that makes a lot of sense. I don't think it's necessarily like the second you get a lower CPI print, then the Fed's like, oh, we can kind of reverse course now. But I think obviously inflation metrics are a big piece of what they're looking at for sure.
Definitely, it'll be interesting to see how everything plays out, especially considering the whole energy situation. And there's a good argument that CPI will not go lower, even with the rate hikes, just because of the whole situation going on there. We can move on to. Do you have anything else to say, Blake, before we go on chain?
No. That about sums it up.
Sweet. Yeah. So onto the on chain stuff. Bitcoin's really approaching the realized price. So that's a huge psychological point because it's the average cost basis of all the market. So when we are below that for a certain amount of time and then we get back there, some people may be interested in like cashing out and breaking even, sort of. But if we can break through that level, then that's a good sign that like maybe the bottom is in. It tends to serve as resistance during bear markets and support during bull markets. So we'll see how that plays out. It's right at just above 21,000, the realized price, and right now Bitcoin I think is what low 20s. So we're right there. We'll see if we can break through that. A metric I looked at this week was the realized profit / loss adjusted for market cap. So when we initially dropped down to 20K, there was a huge spike. A lot of people realized losses, but over the last few months, the amount of people realizing losses has diminished pretty greatly. We're almost at like a pretty neutral level, and that makes sense given that price is near the average cost basis. And that's sort of what we've seen in the past bear markets is one huge massive capitulation moment, and then slowly throughout the bottom of the bear, like less people realizing losses until eventually you start seeing people realize profits. And that's sort of what we've seen right now. So we've had that mass capitulation. I would be surprised if we saw another wick down and a lot of sell pressure again, similar to this summer. Like I don't expect that necessarily. The holders, of course, still holding, still stacking. The holder net position change has been solid green for the last little while. And when you look at the hodl waves, that's the primary metric we use to measure accumulation from long-term holders. An all-time percentage of Bitcoin is in the hands of long-term holders. And the way I've been thinking about this recently is anyone who's been in Bitcoin for 3/4 or more years, they're not going to have to sell now because chances are they're pretty much like loaded if they've been in Bitcoin longer than that. So you're not going to, even if the price goes down a lot further and we're in like this massive recession, you're not going to really see those people have to sell to survive. Maybe the long-term holders who have only been in for a year or two, you might see them have to sell to survive. But the people who've been in Bitcoin longer than that, chances are they're not going to need to do that. And then the long-term holders that are 1 to 2 years, they're only going to sell if they absolutely have to at this point. Like they would have already sold, they would have already capitulated. So much Bitcoin is in the hands of people who have no intention of selling. And if there's no one to sell to, or if there's no one to sell, then obviously the price like can't go any lower. Liveliness indicates the same thing. We've just been in a huge prolonged period of accumulation right now. Any other time that we've had this much uninterrupted accumulation has preceded a big run up in price. Or I shouldn't say a big run up, but a run up in price. So that's a key indicator, liveliness there. Another thing that's really cool to look at is the amount of new addresses. So we know during bull runs, you're going to see a lot of new addresses being created. People sending Bitcoin, new market participants, people who've been around. Doesn't matter, new addresses. But the 30-day moving average, when it crosses below the 365-day moving average of new addresses, that's sort of a bearish sign, right? It's like the activity that's happening within the last month is less than the activity happening within the last year. But when you see the inverse, when you see the 30-day moving average of new addresses cross above the 365-day moving average, that's pretty bullish. Like a lot of new activities happening now, and that's what we're possibly going to see here very soon. If you look in the newsletter, you can see the chart, but the 30-day moving average is about to break over the 365-day moving average. So that's something we've been keeping an eye on. And also what this metric reminded me of is a lot of people think the spring of 2021 was like the true bull market peak top, even though technically, according to Price, it was fall of 2021. But when you look at this metric, there's a huge drop off in new addresses after the spring bull run. So that double top didn't really have the same like euphoric on-chain activity. So that's a pretty good argument in favor that the first top was the true bull market, so to speak. As we talked about in the last few weeks of the newsletter, there's been a huge buildup in open interest, and some of that has been flushed out, but not all of it. Like relative to market cap, it's still very high at the moment. So we're going to be looking for a big volatile move to sort of clear out some of that leverage. And like I was mentioning with the realized price, I think that could be a catalyst in either direction to clear out some of this open interest. And again, on the volatility, we've covered this the past few weeks in the newsletter, but it's very low right now. And often when realized volatility is this low, it precedes a big move up, or it preceded the 50% drop in 2018. But for the reasons I mentioned earlier, I don't think we would see another huge capitulation like that. I could be wrong. It could be something outside of Bitcoin, in markets more generally speaking, like the 2020 drop. But on-chain's not looking like that would be the case. But who knows? Who knows what's going to happen in the short term? But in the long run, we're definitely like near the bottom of the bear market.
Yeah, Mitch, I think that was great analysis. I really liked your chart that you posted that basically showed the realized profit and loss divided by the market cap. I was curious, is that a Glassnode native metric, or is that something that you created in Workbench?
I created in the Workbench, but I'm definitely not the first person to come up with the idea to look at it like that.
That's fair, because I thought it was really interesting how like the ratio when there's these massive capitulations in price, the ratio of all these bear market bottoms kind of line up, pretty in line, like with 2015, early 2019, March 2020, and then potentially, the July 2022. It's almost like Bitcoin goes through these periods or these capitulations where a lot of coins shift hands at the bottom, and no one really, or very few people, I guess, have the guts to be buying Bitcoin at $200, $3,000, and then $20,000 now. It's kind of interesting how that happens.
I agree. And something I also think is interesting, on the realized profit side, again relative to the market cap, it seems people have taken less profits in the past bull market versus the ones before. So that makes me think, like, people are realizing, okay, selling Bitcoin at 60K isn't really worth it because I know this is going to be worth millions in the future. It leads to me thinking people are really convicted and they're in it for the long term, which I know everyone in this space most likely is, but it's cool to see that on chain.
Yeah, it's a really good point. Also might have to do with, the past bull run just wasn't nearly to the same magnitude as, 2017 or 2013, 2014. I guess it's just interesting how that's the case. So maybe the old holders, didn't see the gains that they wanted, so they weren't, comfortable cashing out, at least part of their position. I'm also curious how you think about, Bitcoin's price volatility versus, the stability of the protocol. I think a lot of people think about Bitcoin and they're like, wow, this thing is very volatile. It's crazy. Few people understand it. But at the end of the day, like the underlying protocol is extremely stable. I mean, like the rule set is basically immutable. Blocks get mined every 10 minutes, regardless of whether, there's one computer on the network, like when Satoshi first created it, or there's, gigawatts of energy being poured into the network. It's pretty fascinating. What do you think about that, the volatility and the stability of the protocol?
You're spot on there. I couldn't have said it better myself. When you're talking to people who aren't into Bitcoin like that, like us, like everyone in this space, we all understand the immutable scarcity and what Bitcoin is. But the volatility is coming from the dollar side, right? It's when Powell makes some sort of speech, and then the traditional financial investors they move money around because they don't understand what Bitcoin is. And like the bull run, that was the money printing, right? It's all the dollar side seems to be the primary driver of the massive Bitcoin volatility.
Yeah, totally agree. I think that's a great point.
Because it's an exchange rate, right? That I try to avoid using the phrase price, but I mean it's the simplest way to describe it, but it really is an exchange rate. If these are two currencies, it's a volatile exchange rate, not necessarily a price. When I quote unquote buy Bitcoin, in my mind, I'm selling dollars. I'm selling dollars to get real money, Bitcoin.
Yeah, that's great, Mitch. I just wanted, you were talking a little bit about, conviction, and I think, which is probably a good segue into Joe's section. I think, the biggest thing to look at to measure conviction is just looking at hash rate in this cycle. Like we see, we've seen 3+ blow ups of large miners, but hash rate soars. Like you just see people just waiting for an opportunity for blood in the water to just pounce on those rigs being sold, which I just think is super interesting. And Joe could obviously talk more about it.
Yeah, I'd like to comment there before we pass it off to Joe. I agree totally. I mean, Bitcoin mining is such a long-term play, right? If you don't think Bitcoin's going to be around for forever, then why would you invest like all this money in infrastructure and computers that can't do anything but mine Bitcoin? It's really the long-term play, and what you see right now during this bull market, it's like only the strong will survive, right? And at the expense of those who are inefficient. So it's really an all or nothing sort of situation. If you can acquire hash and squeeze your competitors' margins, force them to go offline, you're gonna be mining more Bitcoin now, as well as you're gonna be making a fatter margin when the price rips, right? If all the other people are forced to capitulate, it's a lot easier to unplug rigs than it is to get them back online once the price starts soaring. So the people that can survive now, the miners, they're going to win big in the future. But the ones who are forced to capitulate down here, they're going to be kicking themselves for forever.
Yeah, I think that's a great point, Mitch. I can transition straight into mining now since that's a topic at hand. A few stats that I put in the newsletter that I put in every newsletter that I'm just going to quickly cover. Total network hash rate is about 263 exahash per second. The hash price, which is basically the dollar per terahash per day that a miner earns, is about 7 cents. So you're earning 7 cents for every terahash that your machine is producing. The next difficulty adjustment is actually projected to be flat now. This is kind of nice because, like you guys mentioned, hash rate has been soaring over the past month or so. So this will give miners potentially a little break from rising network difficulty. Bitcoin energy gravity sits at 10 cents. This is basically a metric that determines what's the break even dollars per kilowatt hour price for a modern mining rig. And we basically defined a modern mining rig as the mean efficiency of rigs released in the past 2 or so years. So miners' margins are very tight right now. You definitely have to be operating at extremely low electricity rates to be competitive. Fees as a percentage of block reward. So for those that don't know, Bitcoin miners earn a block reward, which consists of a block subsidy and transaction fees. So right now, the transaction fees over the last, I think, is 144 blocks. Their fees as a percentage of the total block reward is 1.9%. Another metric, last metric, is total mining revenue. This sits at about 19.1 million per day, and this was over the last 24 hours. A couple topics mining related that I wanted to talk about today. First one is this has been all over the news in Bloomberg and on Twitter. Basically, there's a good bit of over leveraged, large miners that are under extreme stress right now. Core Scientific, one of the largest publicly traded companies in the world, they actually control the most hash rate out of all public companies. They're under extreme pressure. Northern Data is another one, a private firm. Argo is another one, and Irish Energy. All of these are either basically defaulting or on the verge of defaulting on their debt. And a lot of this debt was issued back in the bull market, the mining bull market of 2021, and that basically enabled the high bull market and the massive margins that mining appeared to have. Basically, enabled a lot of these companies to issue significant amounts of debt and really kind of go all in on mining Bitcoin. Unfortunately, obviously, it hasn't worked out as planned for many of those, and for the firms that were way too over leveraged, they're really starting to struggle right now. We posted a chart actually from Will's company, Reflexivity Research, that basically broke down, okay, what's the balance, the Bitcoin balance of these miners that are under extreme stress right now? And ironically, they actually don't have much Bitcoin, right? We saw public miners this summer really start unloading their Bitcoin treasury, which I think is part of the reason we saw Bitcoin bottom at, or at least as of now, bottom at the 17.6K point, just because there was a lot of capitulation from not only other people in the, Bitcoin and crypto broadly industry, but a lot of miners were selling a significant amount of Bitcoin back then. But at this point, we're seeing a lot of the shareholder equity of these large miners trending basically to zero, but they don't have much more Bitcoin on their balance sheet, which is kind of interesting because there might be more pressure, I guess, on the ASIC market potentially. There might be more opportunities to scoop up cheap rigs, but there's not much Bitcoin left to be sold, at least at these price levels, from those miners that are under extreme stress right now. It's also interesting to think about because hash rate has been ripping basically since September. So unlike what people might think, hearing the news and hearing all these public miners under extreme stress, hash rate continues to trend up. And part of this is because these miners may not necessarily have to turn off, right? The shareholder equity of these companies might basically go to zero, and there'll just be a restructuring where the debt owners basically take possession of the assets, and obviously they're probably going to plug them in or sell them to another buyer that will obviously plug them in, and things will keep operating as normal. So yeah, hash rate, it continues to trend up. I kind of expect that to continue probably for the end of 2022, and then going into 2023, I definitely think there's probably going to be a slowdown in hash rate just because there's been a lot less public future Bitmain orders, just because of the market and the way miner margins are looking. But also, with that being said, about the some of the largest miners in the world struggling big time, not all public miners are struggling right now. So CleanSpark is a unique position. They were very conservative all throughout 2021, selling pretty much all the Bitcoin that they were mining. And during this bear market, they've had a significant cash position that has enabled them to really capitalize on a lot of these distressed assets. And they actually signed a deal with Argo, and they bought 3,800 S19J Pros for about $6 million. So that was a very great deal for them, and they are definitely capitalizing on this bear market. Since the bear market started, they've actually purchased about 26,000 mining rigs, and they still have some cash on hand to make more acquisitions. The second big topic that I wanted to discuss, and it's in the newsletter, is kind of talking about the energy industry and the Bitcoin mining industry. So far, the largest publicly traded company to adopt a Bitcoin standard has been MicroStrategy, right? Since that initial moment in 2020, there have been relatively very few companies to follow in Saylor's footsteps. But I think it's possible that we will soon see another large company kind of take a leap of faith like Saylor into the Bitcoin industry. And this is obviously extremely highly speculative, and I don't have any direct insider information about this. But I think, in my opinion, large participants in the energy industry should really be looking deeply right now into acquiring one or multiple of these distressed Bitcoin mining companies. Since March 2020, the energy industry has basically been one of the few sectors in the financial system to maintain its steady climb throughout 2022 this year. And I think much of this can basically be attributed to the lack of supply and energy, and that's basically just because of low capex spending and producing more energy over the last 10 years, and obviously geopolitics as well. But I think energy companies, especially ones with strong balance sheets and steady cash flows, which at this point are still most of them, I think they're very likely to at least consider getting exposure to the Bitcoin mining industry. I think acquiring a Bitcoin mining company basically would enable them to always have an energy buyer of last resort, which is basically a hedge on lower energy prices, and it would basically enable them to capitalize on an upcoming Bitcoin bull run whenever that eventually may occur. Um, so I think there's a lot of synergies between the energy industry and the Bitcoin mining industry, and I think it wouldn't be too surprising to me to see a big energy company step in and really take control of some of these distressed miners.
I agree with that, Joe. I think it's a match made in heaven. I'd be very surprised if we didn't see something like that. And the sad thing is, even if it does happen, like, it's great in the long run, but in the short run, only people in Bitcoin and energy are really going to be able to pay attention to that, right? We've seen so many, like BlackRock started doing their Bitcoin stuff this year. A lot of big players have gotten in during this bear market. I would expect energy companies are definitely eyeing it, and I don't think a lot of the mainstream, like, people are going to really understand the implications of what happens when an energy company does acquire a Bitcoin mining company.
Yeah, exactly. And I mean, it may not happen tomorrow or next month or the next year, but I think in the long run, it's somewhat inevitable. Right now, I guess there is like the stigma that if ExxonMobil just acquired a large Bitcoin miner, the executives there are, one, probably very old, probably don't understand Bitcoin. They're probably rather conservative, right? Like, they don't want to do anything super crazy. They're probably cashing $1 million annualized salaries. Like, they want to play it safe and kind of just keep humming along and not really rock the boat. And a lot of times, from what I've heard, at least at those oil and gas companies, the people that are running those companies have got to the top because they didn't rock the boat. They didn't go out and do crazy things like mining Bitcoin. Like, they kind of just followed orders and slowly rose their way to the top. But I do think that there might be either smaller oil and gas companies or smaller energy companies where the leadership team really understands Bitcoin, and maybe control of the equity is more concentrated. Like, Saylor had basically control of MicroStrategy when he adopted a Bitcoin standard. And I think if there are energy companies where an executive or a large shareholder has a lot of control, it may make sense for one of them to really dive deep into the Bitcoin mining industry right now.
For sure. I think that, I mean, this is purely speculation, but I think Duke Energy could be that company that does that. I mean, they've already said that they're researching it, they're looking into it, but we know how these huge companies, they're slow moving. They take a while to make any sort of big leap, because to them, mining Bitcoin, that's a huge risky move, like you said. So definitely it takes time for something like that to happen.
Yeah, exactly. And I think this may have been posted last year, but I think the Bitcoin conference people mentioned that the largest sponsor of next year's Bitcoin conference was like an energy company or an oil and gas company. So, you know, if that's like truly the case and not just a rumor, and they didn't pull out their sponsorship at this point, I think it would make a lot of sense for them to make it, a big acquisition potentially right before 2023 or the conference.
And something else to notice: oil and gas and Bitcoin miners, they both are sort of battling against the ESG FUD. So it makes sense to combine forces to fight that false narrative.
Yeah, definitely. And Lynn Alden just published a great report on energy, ESG, and how she sees the energy market developing over the next decade. And we actually recorded a podcast with her that's going to get published in 13 minutes. So you guys will definitely have to check that out if you want to learn more about what does the future of, Bitcoin mining, Bitcoin and energy look like in the next 10 years.
Yeah, for sure. Yeah, definitely go check out that Lynn episode. It's scheduled to go up at 1 Eastern, so 12 minutes now. You guys, I know everybody will enjoy that. Lynn's a great thinker. With that, I suppose we can go ahead and wrap up. Gentlemen, you got any more comments?
Yeah. No, I mean, I think this was, a great conversation. Excited about the future of Bitcoin and Bitcoin mining, even though it's very tough times in the space for many players. But yeah, I think, continue to expect the volatility. But I think in the long run, if you're have the strong hands and you're able to survive the dark bear markets, it's going to be a better place in the end.
Yeah, couldn't have said it better. Totally agree. Thanks everyone for listening. Hope everyone has a great weekend. DMs are open if anyone has any questions, but that's all for me.
See everybody.
Thanks, everybody.